So the first question, in Tasha's presentation this morning, we heard a lot of sort of bad news that we sort of all have been feeling, and I think a lot of us have felt a lot of interest in early payment solutions coming, from our client base. So as we think about that, what are your thoughts around, how this is accelerating this interest in early payment?
There's so much happening, and has been over the last 2 to 3 years. And if you think about supply chains as a whole, they're being hit by inflation, which is causing raw materials prices to go up over the last couple of years or so. So stock levels are high. That combination of inflation and higher stock levels is having a negative impact on the working capital cycles. And it's meaning that supply chains need more funding to support their working capital cycles. And that's before you even consider higher energy costs for operating, higher wages, etc., etc. So there is a lot of stress out there, and that stress is building. And of course, that stress is being exacerbated by the rise in interest rates and the cost of funding going up to fight inflation. Which means that actually now is the time for early payment solutions, supply chain finance, etc., because the true benefits of those are reducing funding risk across supply chains, optimizing the cost of funding across those supply chains, and really making the most of the credit ratings arbitrage that exists between buyers and suppliers.
Oz, do you want to make some comments?
I think one of the interesting things about building resilience in supply chains, the financing part is usually very much at the end of it, right? So what we're seeing a lot from our corporate clients is building resilience across the supply chains through whether it's diversification of suppliers, having better access to different manufacturers, different suppliers, different geographies. I think that's sort of come into the fore this year a lot as well. And financing is a way to enable some of those improvements in supply chain resilience. And look, we've seen a lot. The events of the last 12, 24 months have had a huge impact on a number of different businesses. But what we've actually seen as well is the institutional layer of clients, the large investment grade layer of clients, they have definitely sort of felt the impact. But we've seen that those impacts, the cost of funds has been compounded for that small to medium business sector as well.
So great. So the next question that I have for the panel here is around single versus multi-funder solutions for supply chain. I want to start with Mike to give us a little bit. And is it fair to call Kyriba a fintech? Is that the way you guys like to describe yourself?
Sure. Yeah, I mean, the fintech is probably more related to the working capital part of the business, but it's all one single platform. Yeah, I think a lot of what I do day to day in structuring solutions is working through this question of, is a single bank platform sufficient? Do I need a multi-bank platform? First question is, well, who's going to fund the program? So Kyriba, we are bank agnostic, we do not provide funding. And so with that, we need connectivity from banks. And so it's either a relationship bank or it's a non-bank, whoever it is. But does that funder or that bank have capacity to fund your whole program? But if you can't do this with one bank, or I guess kind of a question 1B would be, do you want to have more control over who funds your program and not just kind of leave it to the bank where you can directly reward relationship banks, share of wallet, for instance, and maybe it's Asia, Europe, North America, and you have 3 different banks. That would also lend itself more to a multi-bank platform than doing 3 single, bank platforms.
So Nelson, also be in sort of the fintech space. Is there anything that you want to add to Mike's comments? Just from that perspective, and then I want to hear from the bankers too.
Yeah, no, absolutely. Again, we talk mostly to the suppliers, right? So they are, sometimes they have buyers with programs, but very often they don't. Right? And we very often come to play where there's no buyer program in place. And that happens, I think, more often than you might think. So I think for us, I think it's mostly the suppliers and looking for various funding sources like Modify or other providers or other banks, local banks, who take part of other parts of their business. But if I were a buyer program provider, I would obviously try to diversify my funding sources to de-risk it.
James?
Yeah, I mean, certainly my own view on this and the Barclays view is I'm a big believer in non-bank supply chain finance platforms. For some of the reasons that have already been discussed today, I mean, it does de-risk your financing side, it doesn't make you prone to one bank's credit limit. It becomes easier to group banks around a non-bank platform, not only for relationship reasons, but also for their footprint reasons as well. Because if you think about big supply chains, there are many suppliers all over the world. One of the biggest hindrances to lifting supply chain finance programs, making them to a level of critical mass, is all of the KYC and onboarding that needs to be done. If you start choosing banks as per their footprints, then you can significantly increase that uptake period, because obviously not every bank is present in every part of the world or different countries. So again, I think that's another key reason for me.
I just want to check. You have any comments on that?
Use. I happen to think that one of those things that what we've seen, especially in the last 12 months, and it goes back to that point around resiliency, right? We've seen corporates flock towards our platform specifically because of where we are available and how many countries, etc. But also our ability to distribute and find that setup infrastructure, right? And I think one of the key things we've seen as well is our ability to go to the market to tie into that now ecosystem, because there are a lot of different players now, whether they're non-bank providers or they're bank providers, etc. But tie into that ecosystem and be able to find opportunities for organisations to scale. I think the key question you mentioned was, should it be one bank or multi-bank? I think the future of the ecosystem leans towards multi-bank, but also towards banks or providers who already have that framework and fit under a certain cost model as well, right? Because I think with the bank model, the margin is where the banks make their revenue, and it's not necessarily on that additional layer of cost that sometimes exists.
Right. I mean, I would agree with obviously everything has said. I mean, I think one of the things that we heard earlier today was about that ecosystem and having the players cooperate as much as they can so that the supply chains are more resilient.
I think the other interesting trend that is starting to emerge is some of you may have heard of deep tier financing, and obviously a lot of people talk about the trade financing gap. And at the moment, most supply chain finance programs only go down a few tiers maximum. But of course, there's many more tiers to most supply chains out there. And particularly given what we were talking about economically earlier on, I think the ability to be able to start really reaching much deeper into supply chain tiers is going to be a real driver, I think, in the future. And again, that lends itself not just to multiple banks, but multilateral organizations, development banks like the Asian Development Bank or EBRD, etc., also starting to get involved in some of those programs, because otherwise we quite simply won't have the reach and credit appetites that you need to achieve that objective.
Super. So we started the conversation earlier on some of the drivers behind suppliers, the popularity, if you will, or the need for early payments in the market. One of the questions I want to pose to you guys is, do we think that the early payment infrastructure as it exists today, dynamic discounting, supply chain financing, is that a sustainable? I mean, is the model sustainable? Are companies relying on it too much? I mean, as we start to head into what we think, Tasha was talking about the cycle that's coming, or that she thinks is coming. I think we all sort of feel that. What do we think about, how stable are these solutions? And James, I want to start with you. What are your thoughts there?
I guess to carry on a little bit from what I said earlier, supply chains are often very, very large, very, very complex, and quite frankly, not one product or solution will fit across the entire supply chain. For example, dynamic discounting works really well for the smaller, longer tail of suppliers, where the banks don't want to include those in a supply chain finance program because of the costs of onboarding them, etc., etc. And similarly, banks, their cost of funding and cost of capital works very well at the very large end of suppliers, and therefore their competitive advantage is there. And what we're starting to see now, particularly with supply chain finance and dynamic discounting, is platforms which can do both emerging. There's a number out there already in the market, and what that enables is then a supply chain to use the single platform with multiple solutions on it. And for me, that's really where we need to start going in the future, is the ability to reduce the number of platforms that we all use, and for those platforms to be able to support multiple solutions, because that's the way we can really start to scale, in my view, providing that funding that supply chains need.
Mike, I think you had some ideas on this as well.
Yeah, from the very beginning of supply chain finance, we've always talked about the win-win, right? The win, the buyer, the supplier, kind of equal benefit from these solutions, and it's not always been the case. So, you do have situations, and I'm going to come at this from more of a dynamic discounting, point of view in this case. Suppliers who are now maybe are reliant or over-reliant on those early payments, but also dependent on the ability for a corporate to pay them early. That cash flow is going to be key. And I think what we've seen over the years with dynamic discounting is it may start out really strong, be a great solution, but when things change, and we've seen a lot of change over the last few years, cash flow and the availability for those early payments to be made by the corporate can sometimes go away, and that becomes a real problem, not only for the cash flow of the supplier, but also just the relationship between buyer and supplier. So to James' point, I think I'm seeing a lot more of what you might call a hybrid solution, the ability to toggle between funding. This does kind of go back into the last topic, a little bit about multi-funder, but think about a corporate as a funder for some of the transactions as you break down and segment the suppliers. And it could be the tail suppliers, but what I found interesting, just recently we've got some customers that are maybe starting out with dynamic discounting, waiting for their bank to get connected, but needing to get funding to their corporate, their customers, to their suppliers. And then as the program grows and maybe outgrows the funding of the corporate or the buyer, then you start to layer in bank funding and maybe do that on the strategic side of the spend file. I think that's really becoming more of the trend, and I think in my mind a little bit more of a kind of best case or leading way to do a supply chain finance program.
Yeah, I think in my experience, we're seeing more clients think about that strategic end of the spin curve, as you talked about, that Pareto curve, as a source of funding for the early payments on the dynamic discounting. So it's a self-funding sort of, not completely, but it can be a source of funding.
Oh yeah,
right. Sort of a virtuous circle. Nelson, I know that you spend a lot of time with suppliers. What are your thoughts?
Yeah, I think the segmentation is super important, right? And I'm a little bit skeptical about the segments where the corporate has to step up. I mean, it's also when you zoom out, right? You basically create a problem and then try to put a bandwidth on it, right? So it's a bit, like from a supply side, difficult situation sometimes to cope with. And what we saw when COVID hit the first time, it was the big corporates who basically got themselves payment holidays and were not willing to support the suppliers. Right? So as soon as it became cold for them, they kind of said, okay, we are out there alone. For us, that's good because that's our opportunity. But I think we have to be really conscious about the smaller part of the supply chain suppliers. I mean, those are really out in the cold. Very often they are banked, but they don't get the local bank support very often for the accounts receivables against buyers outside their home jurisdiction. And the large banks, again, I think are stuck in the middle where they say, well, we could and we support those wire programs, but if I have to onboard now a customer in China, in Mexico, in Bangladesh, it costs me $20,000 at least, I would say. It takes probably 6 to 9 months. So what I see and what I think is encouraging for fintech like ours is that we are starting to see now projects where the larger banks have multi-jurisdictional programs set up, and then they realize, okay, I need a solution now for a country which I can't really cover. And this is, I think, where a company like Modify come into place where we have like an automated, faster onboarding, we can actually do things a lot faster. I think, than typically a bank, and in those markets which are not their home markets. So I think segmentation is something very, very important.
Great, thanks. And this is kind of a segue into the next question. The previous panel touched on this briefly, and I don't know that we're going to spend a ton of time on this, but I want to talk about the FASB sort of guidance that recently came out with respect to the supply chain finance solution, and how that impacts. Again, what we were kind of talking about is this potential moral hazard of setting, getting these companies accustomed to this funding, and then we have some exogenous sort of shocks, macroeconomic shocks, et cetera, where funding participants might retreat and leave the suppliers sort of high and dry. Now we have a situation with the FASB talking about disclosure. Do you think this is going to impact the prevalence of supply chain finance programs? And I'm talking particularly about the approved payables sort of solution. So I know you've got some thoughts on this. Why don't you share those with us?
Yeah, look, I think I'll start off the answer by saying that more transparency is a good thing, right? So, and that's I don't think that there's any two ways around it, right? So the more transparency is a good thing, right? I think what will happen come the time when clients need to start disclosing these programs. So we've had a lot of questions, and they've said, are ratings agencies going to look at this debt from now on, etc. That's not the guidance that we've been given, right? And I think if you adhere to clean structuring, and this is where clean structuring does come in, if you adhere to clean structuring and actually work on more vanilla chocolate strawberry type structures than the Baskin-Robbins 31 flavors of structures out there, right? I think you're in good stead. And I think a lot of the key banks do structure correctly and also and set up programs that will last the sort of test of time and the test of transparency. And then then there are other providers who get a little bit more creative, and I think disclosure will perhaps push clients to review some of those arrangements. And I think, frankly, I think that's, as long as your transaction fits within a regular trade cycle and you're not trying to do anything too much outside the norms, then I think transparency is a really, really good thing. And frankly, I think it will normalize. It will actually normalize this type of financing, and will perhaps lead to more of its proliferation to clients who did not previously think about it. Because that's the sort of the difference that I always make with some of our clients. With say a cash account, it might be commoditized, but it's also not discretionary. You have to have one, right? Whereas with some of these more working capital solutions, they are discretionary. And I think in the age of free money drying up over the last 10 years, if you're not thinking about working capital, then you're already behind the eight ball.
So James, I want to ask you sort of the same question, to get the banker view, and then if there's anything in addition to what Oz was sharing.
So I completely agree with what Oz said, and like he said, for me, one of the key principles is supply chain finance should never seek to extend payables periods beyond industry norms. For me, that's a real key principle. And we've talked earlier on about a lot of the benefits of supply chain finance programs, producing more sustainable finance for suppliers at a cheaper cost. This is all good news for suppliers, and all at a time when large buyers are being looked at by their investors and shareholders and so on, through a lens of, are they being more responsible, are they being more ESG conscious, etc., etc. And actually, you can flip this around the other way by having to disclose they've got supply chain finance programs. If they are at the same time disclosing what benefits are and why they're doing those, then I think that becomes an opportunity for large buyers of a different sort, not only to promote benefit across their supply chains and make their supply chains more competitive and sustainable for the future, but equally to show their investors and shareholders that they're doing the right thing.
I think that's a great comment, and my own personal view as a banker is that in some respects, and I have to be careful how I couch this, I think the disclosure requirements and the fact that they are somewhat restrictive in terms of what the disclosure needs to contain is incredibly helpful because it will create comparability across firms for investors and other consumers of financial statements. But it will legitimize the solution even more than it, it's a very ubiquitous solution today. I think I heard a comment that most buyers that, want a program already have one. I don't know if I agree with that completely, but there are a lot of programs out there. I think if we get some standardization, then it will only make the market grow more. So I was actually kind of excited that the FASB went there. So we're coming to. Did you?
Yeah, I mean, as a recovering banker, I'll give you just a few thoughts. I think exactly what you said.
What does it feel like?
Well, you can see, first of all, I didn't wear the tie. I didn't get the memo.
We can take our ties off.
I can't remember what I was going to say. No, I think legitimizing what we've been doing for many years is like primarily, I guess, if I look at this from a, through a positive lens, that's probably what it is. Keeping these programs within certain parameters, giving us guidelines, and then so that the buyers have hesitated, because I think there's still a lot of them that haven't moved forward to do a program because there is some negative connotation to that. All that means is I'm going to push my suppliers out as far as I possibly can. Again, not a win-win, right? And so I'm not going to do that to my suppliers, and maybe overlooking the fact that suppliers desperately need, liquidity in today's environment.
Great, thanks, guys. So we're coming towards the end of our time, and I want to sort of get each of your sort of views on where you what's version 2.0 going to look like over the course of the next, say, 5 years with early payment programs. But you get both on dynamic discounting. One of the things that we talked about or Mike talked about is, on a platform where a client, we typically have seen people focus, and I'll speak as a banker, we focus either on payables or receivables. That's, and we get very laser focused with our client dialogues on those solutions. But what I'm starting to see is a little bit more of the, hey, I want to look at both sides of my balance sheet, right, and optimize working capital there. I'll start with you, Oz. Where do you think we'll go?
Yeah, look, it goes back to one of the things I mentioned before. Where we are in the cycle now, where we're having clients who would normally have told us in the last 2 years that they're not interested, suddenly come to us in November, mind you, and say, hey, we need something done before the end.
Yeah, been there, done that.
So we're pushing and we're trying to get everything done, etc. So look, I think working capital is now forefront of the agenda, and there are some tried and tested solutions that have dominated that landscape around receivables, around payments, etc. For the past 20 years. I think what we're trying to do, and James touched on this a little bit earlier, is look at what's next. What's the next evolution of this space? Innovation is key. Partnerships are key. We've started looking at things like deep tier financing through partners. We've also started looking at partnering with other banks with things like the Trade Information Network, right? So a lot of the clients, what's the evolution? You talked a little bit about inventory, but even in the payables or in the receivable space, clients are thinking about financing earlier on in the commercial cycle, not just at the approved payment stage, right? At the purchase order stage, etc. So, partnering with other banks, partnering with fintechs, creating more of an ecosystem rather than building walls and saying, well, you're on that side of the wall and we're on this side of the wall. Given the need that is going to be there in the next minimum 2 or 3 years, no one organisation is going to be able to be able to sustain that themselves. So those partnerships are really that evolution of that ecosystem is really important, and those new wave products and capabilities, I think will really start.
Yeah. So if I zoom out, we are here very deep down the rabbit hole, right? We are all in finance and everything. I see it more as a general trend that B2B commerce is going to be completely disrupted. We've seen the beginnings now in logistics, procurement, platforms, everything. But this is a 110 trillion opportunity. So there are lots of very smart people building platforms, networks, which are not necessarily reliant on banks. Right? It's really procurement platforms, it's marketplaces, storefronts, so to say. Lots of B2B marketplaces popping up. These guys will reinvent and check out how transactions are being done in the B2B world. I think what we are optimizing is a bit the old world so far, but I think in 5 years' time, everything will look completely different because I think there's a next generation of entrepreneurs, business owners there who basically, are also consumers in their normal life, I would say. They want in business what they have as consumers. And at the moment, I think none of us is really doing that, frankly. I think this is something where I think we all need to also think about our place in that value chain, end to end. I think that has much to do with how can I integrate myself, how can I really have a smooth process, taking months, days, or processes, onboarding processes. All these different microservices, they will have to be radically digitalized, I think. And we see here and there already things popping up. But I think the bigger picture is definitely something where in 5 years' time we'll have very different use cases, a much higher demands from customers, be faster, be more flexible. So I think it's not only about a partnership between, let's say, fintechs and banks. I think that's great, that's happening, and I'm all for it. But I think that the market side will demand much more from all of us. And working capital is a very important part of it. Payments, I think people really rely on payments and working capital, quite frankly. They just want to have money flows, collecting early payments and get disbursements right. I think these are things which in the developed world we are all taking for granted. In the markets we are in, very often just like basic stuff simply not working very well. It's like, getting those dollars into a country or out of the country, make it available to the entrepreneur who actually needs it. It's incredibly difficult sometimes. And this is, I think, where tech can really make a big difference. So I'm positive that we'll see a lot more revolution, I think, with broader space.
Well, I take it. It sounds like you're an optimist, so that's good. That after the way we started,
by definition, I have to.
Yeah, you're an entrepreneur. James, your thoughts?
Well, firstly, as we go into next year, it's not going to be an easy year. And for me, that's where the opportunity lies, because I don't think we've collaborated enough in the past around standardization, around consistency, around building platforms which can really be extended and used far more broadly. And I think that's a real opportunity for us. And the thing that's really interesting me at the moment is the whole risk around climate change and the drive towards more sustainable finance and ESG criteria. And regulation, I think, is going to start driving this quite quickly in terms of data that will be required on different companies, suppliers, etc., with Scope 1, Scope 2, Scope 3 emissions, etc. At the same time, a lot of that data I think, will start to come quite closely interrelated with some of the KYC data that banks are required, financial crime data, and so on. And some of the technology that I'm starting to see in collaboration, I'm starting to see now across banks and technology companies and so on emerging, is really exciting because it's starting to bring all of that together. So ESG data, KYC data, financial crime data. And I think when you can get to a point where you've got a more consistent means of collecting that data, a more consistent means of measuring that data, then you have a much higher level of interoperability, technically, legally, etc., and the ability to really then really start to work on closing that trade finance gap, which everyone talks about.
Great. Mike?
I think the one thing that we don't talk about enough is the receivables side, and how we automate that, how we make that more efficient. We have a lot of conversation with customers on how to, automate the receivables process. Stop secure email to banks for drawdowns, have more visibility to what their credit utilization is. It maybe not as sexy as what's been set up here, but I think that's really a direction it's going to go. I think the payable side has been probably not completely beaten to death, but I think there's a lot of opportunity on the receivable side. And then we don't really mention inventory, as when I was in banks and you guys, but that's, I think, an area that we still need to see innovation. That's, when you talk about a cash conversion cycle, maybe that has the most impact, potentially. And so I would expect that. I know there's a few in the audience and in the conference here that are looking at that really closely. So I guess those are kind of my thoughts aside from what's already been said.
Great. And so now we've got just a few minutes left, and we've gotten some questions that I want to pose to the team. James, you talked earlier about deep tier financing. Do you think ECA support can make a meaningful difference in how that is approached?
Yes, I think it can, to be absolutely honest. And one of the things that we're certainly seeing at the moment is a much higher level of support coming from ECAs across many different countries, particularly across Europe, UK and Asia as well, increasingly. And obviously I'm from London, and we have our ECAs, UK Export Finance. They're very aggressive in the range of different solutions that they're developing. So they've got a range of solutions aimed at providing working capital directly to exporters, but equally they've got the traditional buyer credit facilities, and across a range of different sizes of companies as well, everything from small and medium-sized enterprises all the way up to much larger scale. So for me, absolutely ECA is a relevant part of the picture, as are, as I said earlier on, some of the other multilateral organisations, the Asian Development Banks, the EBRDs of this world, and so on. Because otherwise we just simply won't be able to scale the provision of funding and the availability of credit appetite to the degree needed to close those gaps and to really get down into those deeper tiers.
Great, thanks for that view. And I'm going to pose this next question to Mike, because we touched on this a little bit earlier when you were talking about the payable solution for the strategic suppliers and then dynamic discounting for the long tail. The question is, how do you see, I think I know how you're going to answer this, but how do you see virtual accounts, or virtual cards fitting into the working capital strategy? And do you factor that into spend analysis for a comprehensive sort of client solution?
Yeah, I think that's, as we talk about payables and payable solutions, maybe we forget about that. Could just be because I don't address it day to day. But anytime anybody comes to me and says we have a card program, probably tell them to see how far they can come up their spend file before the acceptance runs out. Yeah, you definitely want to leverage that. I think it's all part of a comprehensive approach. I think what we were talking about before between dynamic discounting supply chain finance is, do you segment suppliers and leave them strictly in each bucket, or do you try to merge them together in a more hybrid approach? And sometimes it's a pricing question as to whether there's going to be acceptability, but ultimately what you want to do is toggle between the two and not have the supplier have any change in their experience. And part of that lends itself to banks or funders kind of needing to be willing to intermittently fund and not have like as consistent a funding, but at the same time if you can do that, it's most likely that the pricing will be higher than what the banks would have come in at. And so when they are funding, their return is much higher. And so it's really a more efficient use of capital if you can make it all work. But it does come down to segmentation of suppliers, pricing. But as we see these programs and the cost of these programs go up, they're starting actually to kind of at least approach more of a dynamic discounting value proposition for suppliers. And so I think in that case, or in that sense, it may be more easy, or a little bit easier to do a hybrid program.
Great, thanks. So we've got time for one more question.
and I'm going to pose this to both Oz and our friend from Berlin. What impacts do you see from rising rates on the demand and advantage of various SCF programs versus other financing solutions? So it's a kind of a broad question, but I guess let's narrow it to, do you see the rising rate environment negatively impacting the demand for supply chain finance solutions?
No.
That's what I would say.
No, the rising rate environment is definitely having an increased demand for these type of programs, both on the buyer side and on the supplier side. And I think I touched on it a little bit earlier before. When borrowing costs are 6, 7, 8%, etc., in different jurisdictions and countries, suddenly discounting a receivable that's SOFR plus 100 basis points or like 150, etc., seems like a more attractive proposition and an easier source of funding.
Nelson, what are your thoughts?
Yeah, I think if you have a program in place, I fully agree. I think my answer would have been, quite frankly, yes. I mean, we see it all the time that when we have suppliers who basically have to take a decision whether they take an order or not, it's really about affordability. Can I finance it? Yes or no? If I have a buyer program which finances me, great. If I don't, maybe we are around or maybe not, right? And I think what we see that, I mean, on the one hand, everybody wants to have these hard orders. Order books don't look so great these days, I would say. Less hard coming order. So people are very eager to get these orders done, but they do the maths, right? So if we, for example, we also pass on our cost of funds on so far, and we are working on a pay-as-you-go model. So every time you want to use us, you can decide whether you want to use us or not. It's not that you're kind of baked in, you have to use us. And that definitely, I think, leads to sometimes at least considerations whether they want to take the order or they want to take the order and get funding from us, or whether they can, maybe even do it by themselves. So I think pricing has definitely a role to play here, and it's obviously getting tougher for the suppliers to factor that in.
Great. Well, I think we're at the end of our time, so I want to thank the panel. It's been a great experience for me personally, getting to know you guys and working with you and prepping for today. I think you brought a lot of expertise